Welcome back in to Clear Path Retirement Radio. I'm Stuart Smith, and I'm here with Mitch Davies, and he is going to give you his take on the markets in our weekly segment, Mitch's Market Minute.
Thank you, Stuart. As always, I'm excited. This is my personal favorite segment. What we're going to do is follow the same structure that we've been following. First, we're going to discuss, where the markets are at today, what's going on this week, this month. Second, we're going to talk about, any economic data, anything we need to be watching, anything that's just reported. And third, we're going to talk about our focus, what we're focused on, what sort of market sector rotation, what are we doing? And we'll talk about that today. But first, overall, this week's been slightly positive, still really choppy. S&P still sitting in that mid 6,800 range. The Dow Jones just under 50,000. We broke through that 50,000 range a couple weeks ago. It's since pulled back. NASDAQ in the low 22,000. So nothing crazy since last week, no major move. What we're watching is volatility. We're still seeing increased volatility. And a metric we use to follow this is the VIX. Maybe you've heard this term. It's the volatility index. And we're sitting at around 18 on that index. We like to see that closer to 15 in a healthy bull market. What that tells us is we're still a little high on volatility. There's still a lot of uncertainty regarding pressing things in the world, like the tariff situation, inflation, a lot of these things. And the main thing that's came out recently, we're always watching economic data that plays a huge part in the markets, and the markets are very reactive to this stuff. The most important development that we've seen was the GDP numbers that just got published. We came in at, I believe it was 1.4% for Q4 of 2025, which was significantly down from not only expectations, but the prior quarter. You want to see that 3 to 4% range for healthy gross domestic product. This is just what the U.S. produces. And we want to see that growing. We want to see that at a healthy range. And that was concerning. Other than that, we haven't seen too bad of numbers. The PPI data came in good. This is you hear the term inflation. So you're hearing how much inflation is being passed to the consumer. The PPI data is the producer price index. So this is how much inflation is affecting the producer side of things. So distribution, the warehouses, how much is being passed over to the actual producer. So that's still holding steady. Inflation is looking okay. But we're really watching that GDP, and we're really watching, again, job growth and unemployment numbers. The weekly jobless claims are still okay. We're still sitting at that 200,000 level, which is healthy. The unemployment data that we got a couple weeks ago was down from the previous one. We'll have another report on that in a couple weeks. So we're watching unemployment, we're watching jobless claims, and now more importantly, we're going to be looking for the Q1 2026 GDP. So big stuff, big implications there. And the main thing I wanted to talk about today is what we talked about last week. And this is what we believe to be the focus in the markets this year, is the rotation away from that AI race. Everyone's heard it at this point. Are we in an AI bubble? Are we overvaluing tech? And however you want to project it out, the point is the market itself is tired of these huge tech companies just pouring money into AI development. They've been super overvalued. These companies have been propped up by these projections, by these future investments. They're basically gaining market cap. These huge companies are gaining market cap by promising these deals that could take years and years to develop that we don't really know if are going to pay off or not, right? We don't know. AI is exciting. AI is taking over a lot of business work. We don't know how it's going to pay off. We don't know how it's going to scale out. So what we're starting to see is a lot of these companies just rebalance in valuation, which is healthy, right? These valuations were extremely high. And where that rebalancing is going is into these defensive value companies, into the two sectors we like to call consumer staple and consumer defensive. Yeah. And what that really means is the companies that aren't just building into this AI hype, that are the backbone of the economy. We've got think of the things that we use every day, like Walmart, Dollar General. Think of the consumer staples that you need to go to buy groceries. Think of the things that you need to keep the energy on, the lights on, the trash going, all the things that keep the economy rolling that don't have to do with tech or robots or anything exciting like that. That's where our focus is. So, one thing I'd like to challenge again to retirees especially is take a look at your portfolio. And if a lot of your growth, a lot of your performance the last couple of years, which it likely is because this is what you've been wanting to do the last couple of years, is be invested in these tech companies. If you're still allocated the same as you were in 2022, 2023, 2024, consider, and even last year, consider maybe shifting some of that over to these sectors that we know aren't going to go anywhere, that we know aren't overvalued and just artificially propped up by exciting announcements, that we know are continuing to pay dividends, continuing to pay employees, that we don't want these companies that might be losing jobs. You want companies that are going to have to keep people going and the doors open and consumers coming through. So this is where our focus is this year. This is where we're trying to reallocate a lot of our clients to capture some of that upside as we shift away from tech. I think over the long term, a lot of these tech companies will do fine, right? But we've seen this overvaluation for a couple of years, and it's just needed to resettle. And I think that's where we're at right now. But that's what we're focused on for the year. We'll look forward to checking in on some of this economic data, checking in on where these companies are at next week. And Stuart, I'll take it back to you.
Hey, and just to kind of parlay that into more of the retirement investment planning that we do, most of the plans that we build for folks, we're very conservative on the assumed rate of returns that we have on the assets that they own, typically in that 6 to 8% range.
Yep.
And, we don't need to be invested in a lot of these tech companies in order to achieve that. You're taking a lot of risk by doing that, and we can achieve those type of numbers with much safer, like consumer staples, those type of energy, the things that we're talking about here. So that also kind of lends itself to making sense. And, the other thing that I'll say is, at least for me, I feel like we've seen this movie before, in that there are companies that are just investing billions into AI infrastructure and into the AI play, and that's great. But we know from history that there's going to be winners and losers there.
Absolutely.
And if you look back at like the .com bubble that happened back in the 2000s, there were clear winners and losers looking back. Now, at the time, we had no idea, but there were losers like Kmart. Kmart lost huge. Walmart, on the other hand, was a huge winner in that deal. Yeah. We've seen other companies that have just gone away because of because they invested incorrectly at that time, and that's exactly what's going to happen with some of these AI companies that are pouring this money in. Is some of them they're not going to be around in 5 years.
Right.
And some of these companies are going to explode because it's going to pay off and they're going to be winners. And do you really, in retirement, want to be playing that game of trying to pick the winners and losers right now? I think there's just way too much ambiguity and too much fog in that whole picture right now to be trying to do that, when you could be investing in things that just are still going to get you to the rates of return that you need to maintain your lifestyle, but aren't going to involve the kind of risk that we're talking about in these tech plays, right?
Absolutely.
So I think that's great job, Mitch. I think that's great stuff to be thinking about. We are definitely investing for our clients much differently in retirement than they were invested when they were in that growth mindset. Yeah. It's a different ballgame, like we've said a million times. You're shifting gears. It's more about protecting what you've worked so hard to grow and controlling the tax picture the best that you can. But, the investments definitely have to be done in a much different way in retirement. You have to take a bunch of that risk off the table, and you have to still be invested to hedge inflation. You have to be careful here. This is a tricky deal. And again, I've been doing it for 2.5 decades and with a lot of success and an amazing track record of helping my clients hit those income goals, live the retirement they wanted to live. And that's what we do.